Welcome to the Starkey Multifamily Podcast. Today I have with me Ann Hambly and Stephanie Whittington. Ann is the founder and CEO of First Service Solutions, the industry's first company dedicated to CMBS borrowers and owners. Prior to founding First Service Solutions, Ann spent 35 years working in and leading some of the nation's largest servicing organizations. Ann is a sought-after speaker, author, teacher, expert witness, and advisor in the CMBS industry. Most importantly, Ann has a tremendous passion for helping and serving people. Some major achievements are named Legend and Woman of Influence in Commercial Real Estate by Real Estate Forum, named Top 10 Most Distinguished Women in Commercial Real Estate by the Mortgage Bankers Association, inducted into the Commercial Real Estate Hall of Fame by Real Estate Forum, and just recently received the prestigious Counselor of Real Estate designation. And then also Stephanie. Stephanie is the Director of Assumptions and Consents with First Service Solutions. She has successfully closed over 200 CMBS loan assumptions. Stephanie is a member of Commercial Real Estate Women of Dallas and has been a panelist for real estate and CMBS conferences and is a regular guest speaker on the topic of real estate and compliance for the University of North Texas. So thank you for coming.
Yeah, happy to be here.
Thank you for having us.
Yes, thank you. So let's start off with a fairly simple question, but just so we're all on the same page, what is CMBS? What does it stand for, and what is it?
It stands for Commercial Mortgage Backed Securities, and it's really a form of lending for commercial real estate that allows someone to originate loans and then get them off their balance sheet. So ultimately, the loans are sold to investors on Wall Street. So it's a Wall Street funding source, in essence.
So is that pretty much all of them, or what commercial loans would not be considered CMBS?
Well, borrowers have, multiple choices for their lending options. So they can go to their local bank, they can go to a life company, the agency, Fannie and Freddie and others, of course, originate loans in this field. And then one of the options is typically CMBS. So it's just one of a number of lending sources. There's like $4 trillion in commercial real estate outstanding right now, and less than 10% is CMBS, but there is a component that's CMBS.
So when you go and get an agency, Fannie or Freddie debt, are they converting that to CMBS, or how does that work?
Sometimes, but not always. So Fannie and Freddie can be their own they can originate it, and it's done through a bank or a life company or one of their originators, or it can be originated and then also put into CMBS, into securitization. So it can be either.
So the borrower may not even know prior to getting it, or would they find out later on, or just maybe not even know?
Yeah, sometimes borrowers don't know. They just close. They go to their local bank, close a loan, and then later on find out when in fact, sometimes they close their loan, they pay their payments regularly to one of the big CMBS servicers, can be Wells Fargo or Midland, mm-hmm. and only when they need something a little out of the ordinary do they find out that their loan is really not held by Wells or Midland, but it's actually CMBS. So sometimes borrowers don't know in the beginning.
Right, they'll call and want us to reach out to their originator because that's who they think they need to go to.
Okay. So that's a good segment to what is a servicer?
Servicer, in fact, the best story here is, I have to tell you, way back in my career, I worked for a company that originated a bunch of CMBS loans. I won't even give the name because the story's funny, and I don't want to disclose the name of who it was. But the originators were originating a lot of loans, and I went to them and said, by the way, I need to get a copy of those loan documents after you originate the loan. And they said, look, what do you need those for? And I said, well, as head of servicing, all the things you write in those loan documents, I have to now go do for the next 10 years. So servicing is really everything that happens after the loan is originated. So it's a bill collection. You send out payment reminders, you collect payments, you make sure taxes and insurance are paid. So there's a whole lot of functions that are servicing.
Okay. So let's move into when you're buying a property. I think a lot of people overlook this, but you really need to understand the current debt that the seller has. Why is that important?
Well, you need to understand the current debt and also who the seller is, because we have a scale in back of us. I don't know if you can see that. The assumption process is really a comparison of buyer to seller as each stands today. The property's already there, the loan's already there. So what the servicer during an assumption wants to do is make sure that by putting in the buyer as their new borrower, they're not putting the trust in any jeopardy or putting the property in any jeopardy. So they want to be sure that the buyer is at least equal to the seller.
So, and then maybe even it would be important when buying it as well, just to make sure that they can sell it or that the loan can be paid off or prepayments.
Yeah, the first thing that you want to do as an owner, if you're going to sell your property, is look at the loan that's in place, figure out if it's, number one, assumable, and number two, I guess, whether or not it's prepayable. And what you find with CMBS loan documents is that they're not prepayable. They usually have provisions for payoff, but it's generally a little more complicated and very expensive. And so most of the time, a CMBS loan will have an assumability clause, and it will need to be assumed. And that's what Stephanie was going through, was the assumption process.
Okay. So yeah, so she talked a little bit about the buyer being equal to or better than the current owner. So what things are they looking at for what's better and what's not as good?
Sure, they'll look at really three main things, in my opinion. One is the current guarantor compared to the proposed guarantor and their net worth, their experience, how much they'll own in the ownership structure. And then the second is property management. Which entity, which company do you plan to insert as the proposed property management? And then third is the overall organizational structure itself. What does their proposed organizational structure look like? Is it a family company stepping in? Is it a REIT? Is it a fund? Is it maybe crowdfunding? Do they have a ton of tiny little investors? So it really depends on what the buyer stepping in looks like compared to the seller. Because if you're going from maybe a very, very large fund to a family owner, that might not be a bad thing if the family owner has a ton of real estate experience and a similar balance sheet, but it could be a bad thing if it was the opposite and they don't have quite as much experience. In addition, the more detailed organizational structures usually require a lot more underwriting and a lot more changes or some changes to the current loan documents. So they could be needing some modifications.
So that, so a couple of questions on that. So, when you talk about, some of those qualifications, now if you're syndicating, are you able to bring in extra people to accommodate those in most cases? So net worth, maybe the seller has a huge net worth, but you can bring that together with maybe a couple people on your team.
There are pros and cons to that. I would say the pros are you can bring in more partners, you can add them to the guarantee, you can add them as guarantors. The cons are usually proposed guarantors need to have at least 10% interest. And so the smaller you get, the less likely that the servicer would accept them as a proposed guarantor. So there's some give and take there. In addition, they want to know who's in the game. They want everybody to have skin in the game. So they don't want a ton of tiny little investors that may not know each other. Mm-hmm. And they prefer to have, some larger investors that have skin in the game, that are going to be making good decisions and are there to stay.
So we always like to talk, though, in this aspect about the Bill Gates theory, in air quotes. And the theory is if Bill Gates happened to own any CMBS, debt, right, that he would probably never be able to sell it because there's never anyone, very few people who can get on the other side of the scale and keep the scale equal. I know I sure could. So there is something called that Bill Gates theory. So there is a little bit of reasonability. If you've got a $10 million loan, if Stephanie's selling it and her net worth is $100 billion, well, I don't need that to assume a $10 million loan. So as long as a buyer, I have sufficient net worth for the size of loan, then that's taken into consideration too.
Okay. Well, that's good to know, because I assume a lot of people, at least listening here, are going to be syndicating. And, I know that can be part of a challenge. which you're familiar with. I recently have spoken to you about one I was looking into, and that was a big deal was location and the syndication factor. So does location play a factor largely in your experience?
Yeah, that's a good question. I know you and I had discussed this previously on your deal, and in our experience, location in the same town, and CMBS generally, doesn't, I don't want to say it doesn't matter, but I've never had a buyer declined because they didn't live in the same town as the asset. I don't know how that could occur on every single property in everybody's portfolio. As long as you've got a third-party property manager that's going to be there and you're relatively accessible and you can make it to the property, I haven't had anybody turned down because they didn't live in the same town as the asset. So that was a little bit of a surprise to me when you were going through that.
To add, there are many things that you can't do at the time of a CMBS assumption. The debt is the debt amount, so you can't decrease it, you can't increase it. The property is already where the property is, and they've already got a loan on it in the amount that they've got a loan on it. The interest rate is already predetermined. So the only thing really that's being done during the underwriting of a CMBS assumption is trying to figure out and ensure that the buyer is not, the trust itself is no worse off having the buyer than they were with the current owner. So I just want to add that to your question about location.
Okay. Well, that makes sense. So then the lender is also going to want additional reserves are likely required. Can you go into that a little bit?
Yeah, I'd say that it depends on property type, it depends on what's going on at the property, and it depends on who the buyer stepping in is compared to the seller. So let's say on a retail center, 100% of the tenants were rolling between now and maturity of the loan. Well, we can almost guarantee that the servicer will be reassessing the reserve accounts and making sure that mostly TILC reserves are sufficient to cover whatever's needed between today and maturity. And most of the time they'll say they're not sufficient. So we can almost guarantee that they'd be wanting some more funds either at closing in a lump sum or increase the monthly impounds or a combination of both. So that's one example. For multifamily, it could be replacement reserves. For hotels, almost 100% of the time, the servicers would require 125% of whatever the budget is to complete the PIP would be at closing of the assumption. So there are different reserve requirements for each property type and for each scenario.
So I imagine probably some of the risk factors might apply to that, from the buyer as well that we just talked about, or is that not a factor?
I would say that the buyer and who the buyer is does play a lot into the requirement for reserves. If they're large and they have a very large net worth and they have a ton of liquidity, then the need for reserves may not be as much because the money is there. May not be with the lender, but it may be there, right? They have access to money when it's needed.
So Anne had talked, about the dollar amount of the debt can't be changed. So how does the loan to value affect the assumption?
Yeah, that's a good one. So that one's hit us a couple times just over the last couple of weeks, and it's a growing trend. Specifically with hotels, I've noticed it's just there more often than not with hotels. So what the servicer will do is take the loan to value at origination and compare it to the loan to purchase price, LTP, today using the purchase price that the buyer is paying. And then where the LTP is greater than what the LTV was at origination, the servicer will look to, most often than not, reserve for that gap. So in other words, if the value has declined significantly since origination, the servicer would want to put up a collateral reserve or additional conditions to mitigate that risk.
Well, and let me throw in a little twist to that. Or you talked about if the value declined, but what we're seeing sometimes too is you have the loan that originated a year ago, it's getting assumed today, and there is a gap or a delta between the value at origination and the value today, even though nothing has changed on the property. So it's not always that a value of the property is really declined. It can even be that the appraisal at origination may have been a little higher than what you can really sell it for. In that case, it catches people off guard. And not 100% of the time do you have to make up that difference, but it is a consideration in the underwriting process.
Now, what about the flip side? Can it go the other way? Or is there any concerns about too low of a loan to purchase cost?
No.
So,
On the buyer side, maybe.
No. They're only looking to better their position. They're never looking to make concessions. Sometimes we have buyers who come in and say, the LTV is a big problem, and we'll start talking to them when we realize it's not levered enough. And so unfortunately, the only thing that can be done there is to add mezzanine debt, maybe if we get approval for it. But really that's just one of the downfalls to assuming a CMBS loan. That's where defeasance, which is the payoff kind of premium in air quotes, might be the preferable outcome. So it might be better to extinguish that loan, get a new loan, and pay the costs associated with that.
Okay. So now when you assume these, they're going to want you to manage your cash in a particular way that I don't think a lot of people are expecting. They kind of just expect it's like your house. As long as you pay them, you're okay. But can you go into some of the things that may take somebody by surprise on that, or what type of cash management things are they going to be required to do?
Yeah, I'll take that. It's daily that we run across borrowers who have this issue in CMBS. So what happens is, and let's say you got a new loan, and it doesn't happen as often in multifamily. But let's say it's retail as an example. You had a retail building, you got CMBS debt on it. You have what's called springing cash management, which means you as the owner get to control your cash, all of it, unless and until something happens. And you tend to think, oh, well, the thing that would happen would be I'd lose tenants, market would go down. I mean, it'd be something big. But in reality, the first quarter you send in your statements to the servicer, you find that, whoops, you've triggered this already. And you, as borrower, you say, wait a minute, nothing's changed, my property's performing well. And yet when you get into the specific detail of how the servicer makes the calculation to determine if they get to control your cash or not, you find that there's a lot of discretion on the servicer side about how it's calculated. So borrowers are often, a lot of the times, very surprised when they lose control of their cash on their property. And very, very little that can be done about it if in fact it's calculated in accordance with the loan documents. So it's a really big hot item right now, and borrowers need to be very, very careful about the exact words in their loan agreement when they're getting a new loan, so that they don't inadvertently run into this problem later on.
Yeah, that's good advice. So, so when somebody's coming into the process, when should they contact you? When is a good point to bring you into the process?
Well, let's assume, so if they're getting a new CMBS loan, I would say definitely give us a chance before you sign your loan documents. Give us a chance to review the documents from a business perspective and give you feedback on those kinds of things I just mentioned, like cash management, things that look very benign. The intent is right. Everybody understands the intent, but some of the words don't line up to intent. So, and again, your lender is gone after this loan's made, and now you're in servicing. And it's, so at origination, before you sign your loan documents, if you've already got a loan in place and you're entering into or thinking about selling your property, and you might have someone assume the debt, we should talk right then about the assumption. And anytime there's any kind of, anything else going on relative to needing consent from a servicer, or just for like a lease approval, or maybe money out of reserves, we help with all that. And if you think, God forbid, that there's going to be a problem making your payment in the near future due to any kind of circumstance at all, then the sooner we can talk about that, the better. So we can help borrowers understand what to expect.
Okay. Well, and I've got a few questions on those later on too. So, so let's talk about some of the things that you may need to get permission, or we may have to request from the servicer. So some of those things, I believe, are change of property management or reserve disbursement. Can you talk about those and any others that I may have missed?
I think the best way to describe it is think of, I always think of those old Polaroid cameras, but they're now coming back into style, I think. But assume when you get the loan, the CMBS loan, there's a snapshot taken of the property and everything about what you do, like your property management firm, everything you've got. Anytime you're ever going to make a change to anything in that picture, including who manages the property, a tenant, I mean, anything like that, you have to stop, read your loan documents, and understand what, if, when, and how the servicer has to approve. So don't err on the side of making the change and then asking forgiveness later. That never, ever works well. So there's a lot of things that have to be approved by servicer. You're in a very tight little box in a CMBS loan, and you really can't, you have very little liberty to move around in that box without their approval.
So how does that process go? So if I want to change my management, how do I go approach them? Do I go to you first, or how would that work?
Come to us, and it's kind of then that's why we have this scale behind us. Really, I don't know if it can really be seen too well.
Yes, I can see it.
This is on my desk because I mentioned it like every conversation. But the existing property management firm is put on one side of the scale, and the new proposed one is put on the other. And the bottom line is the new proposed has to be equal to or greater than the one you have there today. And that's what the approval is all about. So yes, you contact us. We help you get the approval. It can take 30 days if we're involved. But if you do it on your own, sometimes it takes on a life of its own. So
yeah, I'd say that you need to have the new management agreement draft ready to go. Otherwise, we wouldn't be able to proceed without it. So we've had several times where clients will come to us and they're like, oh, we're still choosing a property manager, or we've chosen one, but we don't quite have the agreements set up. We'd actually need the agreement, and you'd need to have chosen a new property manager and stick to them.
Okay. And then how about CapEx? That's something that some require you approve through them, is it not?
Reserves in general, you'd need to go and get approval for any reserves to be taken out of those accounts. So there's a process for each master servicer or primary servicer, depending on who the day-to-day contact is. And then there's certain forms that need to be filled out, and we'd be happy to help anybody through that process. But there's just a packet of forms that have to be filled out, backup documentation. It goes specifically to the asset manager or a certain department within the servicer's shop, and then we take it from there and answer questions. It's I'd say it's about a week process.
A week or two, yeah. And I'm generally very optimistic, but I'd say we'll allow a week or two. And it's a lot like, I can't explain to you, but every single T has to be crossed, every I dotted, every form attached, right color font, on your ink. I mean, it's very, very specific because they don't want to release this money. So it's a challenge to just get your money back out of reserves. So what would happen, if it was an emergency? I mean, is there a way around that if sewer backs up and it's got to be today? You can write your own check.
So, okay.
And then get reimbursed. There is no such thing as an emergency that you can impose on a servicer. There are definitely things that equate to an emergency if I'm a borrower, but emergencies there's no such thing with the servicer, unfortunately.
Okay. Well, it's good to know. Their own reserves and their reserves. So
yes.
So let's kind of talk about when you get in trouble with your loan, which hopefully none of us do, but it happens, and then they can contact you. So let's talk about what constitutes an emergency.
Yeah, that's an emergency, right? So what constitutes an emergency is the minute you think and then in this case, unlike what Stephanie said about getting approval for change of property management firm, don't wait until you have a document, all that.
Right.
In this case, if I'm looking out and I can see that in a year, I'm just making that up arbitrarily. I've got a tenant who's moving out and I'm not sure exactly what I'm going to do yet. I don't know who's replacing them. I've got a hotel and my flag expires in a year and I'm not sure what I'm going to do. I got a lot of money I have to spend and I don't have it, or any number of things. Retail, you really hear about those a lot these days. They have a tenant that files bankruptcy. Now I've got an empty space. That is an emergency, and it might not feel like it today because they're still paying for a little while, but you need to come to us and let us talk through what the process is, develop a plan of attack, and just be prepared. So don't wait until, this expression lately that I've heard more often than not is all bleeding eventually stops. You ideally want to stop it, not after all runs out. And so as a borrower, if you know there's an emergency coming or something coming, you're going to start bleeding. Don't wait until you bleed out and then call and ask for help, because there's very little that can be done there. Call and ask for help the minute you start bleeding, So.
Yeah, I imagine you probably see that quite a bit. They
Yes.
think they can work through it, and then by the time they admit they can't, they're drowning. So
They bled out. I mean, that's why I use that.
Yeah.
If I wait till I lose all my blood and then go to the hospital, I may not be able to be repaired. So you ideally want to get there before all your blood's gone,
Absolutely.
Same in CMBS with your payments.
Okay. Let's say somebody gets to that point, and what options do they have for loan modifications, or I guess what options do they have if they can't make those payments?
Well, it depends on the situation, of course, but there are times where you may just need a temporary relief in your payments. And so let me back up. What I try to do always is look at the current value of your property with that event that just occurred. Let's say you were notified a big tenant's moving out. Well, with that tenant out, what is the value of your property? Are you upside down? Do you owe more than it's worth? If so, we may need a debt kind of relief or modification. If the debt and the value are fine, and it's really just a temporary kind of payment issue, and you're trying to put a Band-Aid on to stop the bleeding, then that's really like a payment modification. Sometimes that's sufficient. You leave it on for a year, and then you get out fine and all's good. So we try to assess again how over leveraged or upside down is the property. If it is this a temporary issue or a long-term issue, and then try to figure out what the solution would be.
When is a payment modification an option? What has to happen, and what will they be looking at?
Well, it'll be a couple things. One is the value of the property would not be less than the debt. So you're not looking at a problem where you owe more than it's worth. You're just looking for relief in your payment. It could take the form of just going interest only instead of an amortization for a period of time. It's important to note that you don't get those for free. So there's a modification fee. It'll cost money. And so the payment modifications can look different. All of them can look very different. It depends on what it is you need. But the key is to have a conversation with someone who understands what this is, I'd like to say with us, and let us at least talk through what it would look like, what it would cost you, and then you can make, as an owner, a economical decision about what you want to do.
So how likely is the ability, so let's say somebody gets into trouble and they come to you, how likely is it that there is a debt or a payment modification available, or that the lender would just say, well, we're taking it back? What are the odds in favor of them for doing that?
I think 95% of the cases will get some kind of relief from the servicer. Here's the real key, though. The cost of that is what will often make it not worthwhile for an owner. So I'm not saying that 95% of the time a borrower comes to us and asks us for help, we get them a great relief, great debt relief, and they have a closing party and all that. It's not generally like that at all. We'll find out what they can get, obviously, and then we'll consult with them. And often, there's a decision made that, I'm better off in this case to continue coming out of pocket to keep the loan current. It's cheaper than if I went through this process. I might be better off handing the property back. Maybe I'd like to do a workout, but the cost involved in retaining the asset isn't economically smart. So I prefer to hand the property back. And that's the beauty of CMBS debt, is it's non-recourse, which means you can hand it back if you get to that position. So I hope I answered your question.
Yes. So all CMBS is non-recourse, what you're saying?
Yes. We have a few exceptions.
99% of the time.
Yeah.
Okay.
We occasionally run across one where a borrower's actually signed a personal guarantee. But
Right.
so if I went into a bank and I wanted to get a loan against my commercial real estate property, often the bank loan or life company loan will be recourse, which means if I default, they can take my property, of course, that's their collateral. But if that doesn't turn out to pay them fully off, so let's say that property value went down and I still owe them some even after they took my property, they can come after me personally. That's a recourse loan. Non-recourse, of course, is just where all they get is the collateral, the property. And there's always exceptions to that. So on a non-recourse loan, which most CMBS loans are, if you default or the property value goes down, you have the option of handing the property back. And that is a beauty. Now, there are certain ways you can make the loan recourse you can do some wrong things and inadvertently trigger the loan to be recourse. So you have to know what you're doing. And that's, again, where we offer feedback and consultation. But you can, at the end of the day, make an economic decision that it's just not worth keeping.
So that would be, so let's move up over to the maturity of the debt. So there's typically, I think a lot of people don't realize that there is such a small window to sell a commercial property at the end of the financing, or at the end of the balloon. And, commercial transactions don't always go very quickly. So that is not always the easiest thing to manage.
Right.
Could you tell us some things that you can help with that process as well?
Yes. Yeah, I always say, like, paying off your CMBS loan exactly like you're supposed to is almost like putting a bullseye, 100 feet away, taking the dart, and you gotta get right in that bullseye at payoff 10 years down the road. I mean, it's near impossible. These loans are locked out from prepayment, as we talked earlier, and that's so that investors on Wall Street pay the maximum amount for the bonds, and therefore it's a profitable business model. Makes sense. So the loans are locked out. You can defease the loan to get out of it, which is very expensive. Or again, you go through an assumption. Now, at the end of the terms, so they're typically 10-year terms, you have about a 90-day period, which is called an open period, which means you don't have to pay any penalty. You can pay them off. You can't do it a day before, and you can't do it a day after. So you literally have a window of about day 89 to the maturity date. And that's the window you have to close without any penalty. If you close the day after maturity, you could be subject to a late fee. Now you might say, yeah, well, okay, but a late fee on a payment isn't very much, but it's a 5% late fee on the balloon payment. So you have a $10 million loan and you're past maturity, your late fee now is, $500,000. We're paying it off a day late. And you had to have defeased on day 91, which also is expensive. So yeah, you hit the nail on the head. It's a very tiny window and it's got to be executed perfectly. So what happens if life takes over and it doesn't happen that perfectly? Well, you either need to get a short-term forbearance to allow you some extra time to pay it off, or sometimes you have to go about a full-blown extension. Maybe the property doesn't support the refinance today and I need another year or two to, stabilize it. Those can be done. And again, we help with that. Yeah.
So should if somebody's at the end of their term and they're planning on selling it, and let's just say they have a buyer lined up to close in that 90-day period, should they still contact you in case that deal falls through, or should they wait till it falls through, or what? when should they get you?
That's a good question. If you're an owner and you're in that, you think you're going to make that period of day 89 to the maturity date, and you're pretty comfortable about that, there would be no reason to contact us, quite honestly, because there'd be nothing for us to do or say other than, that's great, right? Now, if at any point in that process you aren't 100% confident that you'll be able to still pay off by the maturity date, then call us. So the minute your confidence level starts going down at all, from pretty darn confident down, I can't tell you the magic number, that's when you should call, because you don't want to wait until the contract falls out. You don't want to wait till the day before maturity and then, oh my God, call, because then there's not time to do anything. So I know this is really kind of a hard thing to quantify, but that's really what I'd say.
Okay. So yeah, I mean, that's a good answer. It gives a good starting point, at least to be aware of. I think, at least for myself, getting into it, you just don't see those things. People don't talk about that small window to be able to get rid of the property and some of the things you covered. But
well, you're not going to hear it from the servicers because they want your late fee.
I'm sure they do. Yeah. So that's certainly good to know.
Yeah.
So I know it feels like we went through it pretty quick. I think we covered quite a bit. Is there anything we missed or something you would want to add to that?
Well, I would just add, and then Stephanie may have something to add, I don't know, but I would say that, we offer free consultation at all times to anyone. So if anybody listening to this if you have a CMBS loan, or you don't know if you have a CMBS loan, we can look it up. But if you have a CMBS loan, think you might have one, think you might be getting one, then give us a call and let us talk through whatever it is. Worst thing you have to lose is a little bit of time, and there might be nothing to do at the end of the call, but if there is, we'll give you that guidance. So I just recommend people to call. We're here as a free resource. And I know you read all those wonderful credentials. It always sounds funny, but I think the way I would describe my background is 35 years of my career, I lived in the servicing shops. I was a servicer, ran a lot of the large ones, and therefore I know firsthand what they do, how they do it, and how to maneuver through the process. That's really the key to what we do. Stephanie personally has handled more assumptions than I think any other human probably in the planet. So for CMBS, so yeah,
a whole lot of them.
So we're just here. We've got the school of hard knocks. Been there, done it, know what to do, what not to do. Lots of times through many errors, and we can just help prevent someone from doing the same thing and guide you through. We did not. Well, do you want to add anything to that?
No, I think you covered it all. If there was anything I was to add, I would say that we also help clients ongoing. So we do have people that are just here with us all the time. We take care of their portfolio of CMBS loans, and so anytime they need anything, we're right there for them. With an email, a phone call, whatever it might be, and we monitor their portfolio for them. So it is something that we're here for and are happy to do for clients.
Yeah. A good point.
Yeah.
Our website is probably the best thing to leave everybody with, and then our main phone number, and we're here available to talk at any point. The website is 1stsss.com. So the number 1st for first, and then sss.com. And our main line is 817-756-7227. And Stephanie or I are available. We've got a team of other people here in Dallas. We're sitting in my personal office right now, but we've got a whole group outside and team of people, and we love to help wherever we can.
Yeah, I can say you guys are super responsive. You helped me through a difficult process in the one that we were working on, so I appreciate all your efforts there, and I hope you can be of assistance to other people as well. So hopefully this helps and gets you out there, and I appreciate it for sure.
Yeah, thank you.
Thank you, Reed. We really appreciate it.
All right, thanks for coming on.
Okay.
Thanks.
Bye-bye.
Bye.